Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Karl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
We encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast.
Hi, everyone. Welcome to today's podcast. I'm here with Karl Frank from Assets and Income.
Hi, Mike.
Hi, Karl. And I'm here with Nate Merrill with Goodspeed and Merrill.
Hello.
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 How was everyone's weekend?
We're doing great, man. Crazy busy. Beautiful weather.
Memorial Days or Memorial Day weekend, as they call it now. I don't know how that works. It's a day weekend. But Memorial Day weekend is my favorite because it kind of is the acknowledgement that you're ushering. It's like the first major holiday of the year that you can actually use. So,
Did you barbecue?
no, I was out tiling.
You didn't even have time to barbecue?
Oh, we cooked hot dogs when I got back. I came back a little early, but
Excellent.
yeah.
At least you got some of it in.
Hot dogs with chili and some hot sauce.
Memorial Day weekend is awesome for me. It's both my birthday and my anniversary, so it's a big party the whole time. It's just great.
It
Well, happy birthday,
concentrates it
happy
all
Well,
at
thank
once.
you.
Yeah, happy birthday.
Thanks, man.
And happy anniversary.
25 years for the anniversary.
Just getting started.
Just a few more for the date of birth.
My son got married this weekend, so we were up in Breckenridge.
That's huge.
Gained a daughter-in-law. Very good gal.
Family's growing.
Yep.
That's
Daughter's engaged, but not married yet, so that's the next push.
Oh, how exciting. Gonna be Grandpa Mike before you know it.
No, my daughter doesn't want kids, and my son's not eager to jump in and have any kids just yet, so
Not yet, huh?
don't
That
see
could
anything on
change.
the horizon.
That could change. Well, guys, this is great. Today's topic, it's going to be an exciting one. And what we're going to do is we're going to talk about qualified charitable distributions from our retirement accounts. Nate, I know your feelings about IRAs. What do you really think about IRAs?
Well, there are essentially two strata of uses for IRAs. IRAs work great for the bulk of the U.S. population, I think. I mean, I love the idea that people can save, have an incentive to save first and foremost, because that is an essential component of being prepared for the future.
Yeah, that's right.
And having an incentive to do it, I think, is positive, as long as the expectation is, as I think you would agree, that you're going to draw those funds down at a lower tax rate, or you get into a Roth IRA situation.
Which is awesome.
And they're designed well for their target audience, which is don't use the money until you're 59 and a half. Don't have access to it. They always build in little nuggets there for you to take out.
Absolutely.
Take out for a home purchase, take out for your kids.
Right.
So they're getting a little more liberal with them because they realize that this is such a big piece of people's financial profile for the most part. But where I spend a lot of time also is in the ultra high net worth class that won't take out of their IRAs at a lower tax rate, primarily.
Probably not.
Yeah. And it's a difficult asset to plan for on estate planning. So whereas we usually try to get leverage out of estate planning assets, IRAs and 401ks are not one that we can get much leverage out of, except for what we're going to talk about today,
Right.
which is redirecting your IRAs to a different purpose than maybe you otherwise set it up to accomplish.
We're talking charity.
That's right.
Isn't that great? Mike, what do you think about these retirement accounts? Do you have any profound insights like Nate?
No, I agree with Nate. I mean, it's a great, savings and investment tool for the bulk of taxpayers. It's a good alternative there. I think there's a healthy balance, and you'd probably agree, Carl, between using IRAs and Roth accounts. Right? You don't want to get to age 72, maybe 74 in the future, where you have to take RMDs, right? Whereas with Roths you don't have to do that. So kind of got to balance those two out. But if you're using IRAs, to tax plan and reduce your taxes, it's a good tool.
I love it.
People. Yep.
Yeah, go tax free, baby. And the Roth IRA is awesome. But that's not our topic today. Today we're going to talk about the tax-deferred retirement accounts. So in a tax-deferred retirement account, either you rolled it into your IRA from a 401k and you never paid taxes, or you put a pre-tax contribution, or you put money into the IRA and you got a deduction for it. So you've got this money in an IRA, and when you pull it out, you're going to have to pay income taxes on it. And like you said, both of you guys said, in retirement, that can really stink because you got required distributions at age 72, whether you need the income or not. And if you're like some of Nate's ultra wealthy clients, you're always going to be in the highest income tax bracket, and they're going to force you to take money out, pay it at the highest income tax bracket. And then maybe you don't even need it. What are you going to do with it? Well, the qualified charitable distribution might be something to think about. With a QCD. Mike, you want to tell us how the QCD works?
Yeah, you're basically taking money out of your IRA and donating it for a charitable cause. It has to be a nonprofit organization, can be a university, right? And you can contribute up to $100,000 to a charity of your choice. And if you look at it from the tax perspective, right? If you take out a RMD, you're going to pay taxes on it. If you take it as a charitable deduction, you're going to save that same amount in taxes. So it's a matter of, which approach you want to take and how much you want to use. But you have to be 70 and a half. It has to go directly to the charity or the university. I've had a lot of clients have the expectation and understanding that they can take $50,000 and give it to their kid for school, or their grandkid for school, and take it as a deduction for donation.
That would be too good to be true.
That would be way too good to be true. But they have that thought process that, well, geez, I'll just donate it to the school and my kids can use it for their education. And it's like, no, it goes to the school, and the school determines how it's going to be used for that purpose. But and you get a charitable deduction for it. And if you to your point, Carl, if you don't need the money, and we're moving into a higher tax bracket, especially with Biden's plan, looking at taxes increasing on anyone who makes over $400,000. Yeah, it's a pretty good strategy if you don't need the money and you're philanthropic, it's a great avenue to, reduce your taxable income at a higher tax rate.
Right. I mean, you're taking the money out of the IRA. You're never going to pay taxes on it. The charity is going to receive the money and never pay taxes on it because they're a 501c3 charity that doesn't pay income tax. But you can only do $100,000 per person per year.
Correct.
Now, I understand that the spouse can also do it.
Yep.
So between the two of you, if you each have an IRA, you could each pull $100,000 up to $100,000 out of your own IRA and give it away per year.
Right. To whichever charity each of them choose.
Right.
It doesn't have to be the same charity.
Now, one thing I will supplement, just so it's not lost on folks, because a lot of my wealthy individual clients or married clients that would pursue something like this are usually regular philanthropic givers. And then oftentimes they will make a pledge that spans many years. This can be used to satisfy a pledge that may be given in 1 year but paid over several. So
Correct.
Even though it's limited to $100,000 a year, you can make a pledge at that dinner event for $500,000 and just apply your $100,000 a year for 5 years.
So I can still go to the charitable parties and hang out with the mucky mucks.
Totally.
That's exactly
my favorite thing to do. Next to tiling.
I haven't seen you there, Nate.
I go incognito.
Incognito.
Yeah.
I love it.
I believe you can also use your RMD in the same fashion.
Why not?
Yeah, you can take if you don't use your RMD and you got to take it anyway and you don't need it, donate it.
Donate it right to the charity. I love that idea, right? Well, this sounds like a really good idea. One of the things that I wanted to talk about too was that sometimes when you have a required minimum distribution later in life, it can really mess up your Medicare, Part B and everything else, because if you start to pull out income in a regular required distribution from your IRA, it increases your income. If your income gets above a certain limit, if you're not already there, it could force you to pay higher Medicare premiums on your Part B. It's called IRMA for another couple of years.
which is an insult to all the Irmas I know.
I know it.
But, yeah, I mean, that's above my pay grade, although it does make sense that if there's no reason you should position yourself to be treated differently than
Why
other
would you
folks.
want to pay more taxes than you have
Right.
to? And certainly paying more for Medicare stinks, man. I mean, if you're getting the same insurance as somebody else, why should you pay more than they do?
So I want to go back real quickly to address the charitable recipient side of this, because this is, again, I mean, the mechanics of doing this are pretty straightforward, right? Can we agree on that?
Yep.
But it's the what are you doing that gets, I think, it gets me excited is, you mentioned university. If that is what floats your boat, you can certainly do that. Fund a scholarship program, annual scholarship program. So these can be directed. They don't have to go to the general fund, so to speak.
Right.
You can set up a scholarship fund with your university of choice. Obviously, your churches can benefit from stuff like this. But probably one of the most often overlooked opportunities to get the benefit and decide later is using a donor advised fund. And I almost always default to donor advised fund as an intermediary giving recipient, because it allows me to do that $100,000 a year, even if I don't think I have someone lined up to receive the $100,000 this year, or I want to spread it out over a longer period of time. And I know this isn't a podcast on donor advised funds, but this is I think a particularly nice use of the donor advised fund, because you can just move it from one account into another, get your tax deduction, and decide later, right?
Well, the downside is a QCD can't be used for a donor advised fund.
Well, then
I know.
Bummer. But the university would still work. You can still direct it into, university and churches.
Exactly.
Why did they carve out donor advised fund? For the very
idea.
purpose that I just mentioned, is
I
you're not
think
really
so.
giving it away?
I think
that's
so.
dumb.
All right. And you can't give it to a private foundation either. But
Well, that makes sense.
Right. But under one of the recent tax laws, this might change by the end of the year. So there is a tax law going in right now that's been quote unquote unanimously approved in Congress, and we know what that means. It means not at all unanimous, but that could change this. And a handful of other tax geek ideas are going through Congress right now, as I understand it, through the grapevine, that might make this. But under the current rules, we can't. We have to give it right to the charity. We can't give it to our donor advised fund. Bummer, man. How cool would that be, though? Totally agree.
Well, the RMDs you should still be able to do a DAF, right? Or is it under the same rules?
I think it's under the same rules.
Yeah.
Okay.
Yeah. Doesn't make sense that you could do it.
Yeah. One of the big advantages of this is for people who don't itemize. So if you can avoid, a lot of people don't have to itemize anymore.
Right.
Right. If they're living off, a reasonable income, not an excessively high income, then why itemize? And if you're going to get a charitable contribution of any size greater than $300 a person, then you have to itemize. This is a way to avoid itemization and keep yourself in the simple 1040 tax return. So that's a pretty cool advantage.
That's a good point.
Another thing, Mike, and you know this better than any of us here, but you want to avoid an error. You have to tell your CPA that you actually did this qualified charitable distribution.
Please let me know.
Right? Because you're not automatically going to find out.
No, you're not. No,
Yeah.
you have to tell your CPA that you've done this and provide them with the documentation how much you did.
So what kind of what kind of form do you get? Because normally when you take out money from a
It's just
401k,
like a regular receipt, like you do donation.
Yep.
Right? There's no form that goes to the IRS that says
That's right.
1099.
but the taxpayer will still get a 1099-R or whatever it is?
It shows up on Form 8606, which is something that we normally don't give to the CPA.
So it's not going to show a withdrawal from your 401k or your IRA.
Right.
Isn't that crazy? Yeah, there's no checkbox where you can say this is a distribution to a charity.
Right.
They're out of
So
it.
what you miss, though, is the deduction. You're not going to pick up the deduction unless you're notified.
Unless I'm notified.
Okay.
Correct.
Yeah.
So it's not like income's going to show up, though. Got
Right.
it.
There's no income because you didn't get any.
Right.
So you want to do it right.
Yep. Let me know.
But it's a pretty slick idea.
Yeah. And if you donate more than the standard deduction, you
Right. And for Nate, for your ultra wealthy clients, it's a way to get the money out of the IRA before it becomes a problem.
Oh,
in the
absolutely.
taxable estate.
I have clients that are just waiting to turn 72 and a half. Is that
70 and a half.
70 and a half.
It's really strange. The RMD went up to age 72, but the qualified charitable distribution is still at 70 and a half. Who knows why?
Well, I have my own theories on that, but it's called lack of attentiveness. There's so many areas growing, especially around charitable giving, where you were just saying it applies one way but not another, and you just it's not intuitive as to which ones they included and which ones they did not.
Right. And a lot of tax cleanup, and it's so complicated and unnecessarily so.
Yeah. Well, if I can throw in one closing thought or discussion, I know we talked about this a little ahead of time because this is one of my favorite things. If you're now with a Roth IRA, leaving it to your heirs generally works because you don't have the income to the heirs,
Yeah,
right?
right.
It still is includable as a dollar for dollar asset for estate tax purposes. So here we're talking again about people who are above, who knows, whether it's 3.5, 5.5, or 5 or 11.5 million. Depends on whether you have a taxable estate or not. But this is one of the ways in which I have a lot of clients use their IRAs is to leave it to charity.
Yeah.
So that is one area where it's rather unlimited. The deduction is universal. If you leave your IRA, even to a donor advised fund, you get an estate tax deduction for it. So it pulls it out of your estate so that you're not paying estate tax on something your kids are going to suffer income tax on. And if you have any sort of charitable inclinations, it's a great way to just purge it out of your estate.
Exactly. And hopefully if you write that in, then you still get to attend the fancy dinner parties that you love so much.
Yes.
There you go.
It's important to be able to get the swag
The
and the
perks.
dinners and the gift bags.
The perks. Mike, any closing thoughts? Any ideas?
No, I think we covered it. I have a question for Nate, but I think that's for a different topic. So I'll hold that one off till later, and we can add that to another podcast.
I love it. Well,
We'll just kind of piggyback onto this one, but we'll do that for another day.
thanks, guys. This is a quick podcast, but it's one that we get a lot of questions about. There's a lot of confusion. There's a lot of people out there who don't know all these rules, and I really hope this podcast is of use to them.
Agreed.
Right.
I learned something today.
Yep.
Create a beautiful day.
All right. See you guys next time. Thanks.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.